The more an investment rises, the easier it becomes to confuse a stronger feeling with a safer decision. The chart looks better, other people sound more confident, and increasing the position starts to feel less reckless than it did before. But the price move may be the only thing that changed. The mistake is not buying after a rise. The mistake is abandoning a position size rule because the rise itself now feels like proof that the downside has become smaller. One reason this happens is that recent performance can reshape expectations. In an experimental study of risk perception, return expectations, and investment decisions, researchers reported that past returns closely tracked participants' expectations of future returns across the presentation formats they tested. That finding is about expectations, not a forecasting rule. It does not say that past gains reliably predict future market returns. The distinction matters because an expectation can change before the underlying evidence changes. A strong recent return can become the most vivid input in the decision. The investor may still know that future outcomes are uncertain, but the mental estimate of what comes next starts leaning toward what just happened. The rising line is no longer only a record of the past. It begins to feel like a preview. That shift can quietly alter the original plan. A position that once required caution may now feel like an opportunity that deserves a larger allocation, even when no new information has improved the underlying case. This matters most when the original decision was designed around a different price, a smaller position, and a more cautious estimate of what could go wrong. Expected return is only half of the effect. The same full-text study also reported that lower perceived risk and, especially, higher long-term expected returns were associated with a greater likelihood of investing in the study's setting. In plain language, people were more willing to invest when the asset felt less risky and more rewarding. That does not mean the asset's objective downside had fallen. Perceived risk is a judgment. Objective downside includes what can still go wrong, how much could be lost, and whether the position still fits the original limit. Those two things can move in different directions. This is where a rising investment can feel safer than it is. The gain can improve the emotional case faster than it improves the factual case. The investor sees confirmation, feels less uncertainty, and relaxes a rule that was created before the excitement arrived. A larger position then feels like a reasonable response to better evidence, even though the only new evidence may be the price itself. The key question is not, did the investment rise? It is, what changed about the decision besides the chart? The feeling and the risk assessment must be tested separately. The social environment can strengthen the same impression. A separate full-text study of online investor opinions reported that, during rising price conditions, greater disagreement was associated with a stronger shift in overall opinion toward optimism. That result should be kept narrow. It does not prove that online discussion causes bubbles, losses, or the same behavior on every platform. Still, the mechanism is easy to recognize. A rising chart is repeated in rankings, notifications, screenshots, and conversations. Optimistic explanations become easier to find. Cautious views may still exist, but they can feel less relevant when the visible evidence keeps pointing upward. The platform is not creating objective safety. It is increasing the salience of the recent gain. Repetition can make the same price move feel like several independent confirmations. The chart is up, the comments are confident, and the asset is appearing everywhere. The investor then mistakes visibility for additional evidence. Familiarity can look like confirmation when the same signal is simply being recycled. Past experience can shape beliefs even without a specific app. Here the evidence is more limited, because the supporting sources in this pack are available only at the abstract level. One study reported that lifetime macroeconomic experience was related to financial risk-taking. Another reported that expectations and actions among high-wealth investors still showed links to personal investment experience. A third found that several measures of investor expectations were positively correlated with past returns and the level of the stock market. These findings should not be stretched into effect sizes, prevalence claims, or a universal diagnosis. They do not show that every investor becomes overconfident after gains. They show a narrower pattern. Experience and recent market conditions can be related to what people expect and how much risk they are willing to take. That is why experience should not be confused with a forecast. A gain can teach the wrong lesson if the investor treats one favorable period as proof that the next decision carries less downside. Confidence may be based on something real that happened. It is still not the same as evidence about what happens next. That boundary is essential. Consider a fictional worker who has been watching an investment for several months. Before the rise, the worker writes down a fixed position size limit, a downside case, and the conditions that would make the idea unattractive. Then the price climbs sharply. Nothing material changes in the original thesis, but the investment now feels more credible. The worker starts thinking about a larger allocation. The old limit suddenly seems too conservative. The downside case receives less attention because the recent gain appears to validate the idea. Notice what changed. The asset is more expensive. The worker is more confident. The planned allocation is larger. But the evidence supporting the larger position has not improved. This scenario is not a claim about how common the mistake is, and it does not predict that the price will reverse. The problem is the decision process. A pre-committed rule is being rewritten under pressure, while the investor interprets stronger conviction as lower risk. The solution is not to ignore price. It is to separate a price signal from the quality of the decision. Use a 6-step system called the rising price decision pause. Step 1. Write the original reason for considering the investment before looking at the recent chart again. Use the version that existed before the rise. This prevents the current price from quietly rewriting the original thesis. Step 2. List what new information changed besides the price. A price move can reflect information, but the move alone is not a complete explanation. Name the new evidence: a business development, a change in cash flows, a resolved risk, or another fact relevant to the original case. If the list is empty, record that honestly. Step 3. Restate the downside case, the planned position limit, and the condition that would invalidate the decision. Do this in writing. A downside that cannot be stated clearly is easy to ignore when confidence is high. Step 4. Compare the allocation considered before the rise with the allocation being considered now. The gap is diagnostic. It shows whether the decision has expanded faster than the evidence. Step 5. Apply a 24-hour delay to any unplanned increase unless a pre-committed rule has already been triggered. The delay is not a market timing signal. Its purpose is to prevent urgency from becoming a substitute for analysis. Step 6. Hide the recent chart and ask whether the same decision would still make sense. Use the current facts, current price, downside case, and position limit, but remove the visual story of the rise. If the decision becomes difficult to defend without the chart may be doing more work than the evidence. Before finishing, record the answer to one final question. What would make this increase a planned decision rather than a reaction? A planned decision has a stated trigger, an allocation rule, and a downside condition. A reaction usually has a recent chart, a sense of urgency, and a reason that was written after the price moved. This system does not tell you to buy, sell, or avoid an asset. It restores the decision boundary that existed before recent performance became emotionally dominant. It also creates an audit trail. Later, whether the outcome is good or bad, you can evaluate the quality of the process without rewriting the reason after the fact. A rising price can reflect genuinely improved information. Momentum can continue. Buying after a rise is not automatically irrational, and this framework does not predict a reversal. The boundary is simpler. Did the information change, or did only the chart change? When new evidence improves the case, the decision can be reassessed. When the position becomes larger only because the rise feels reassuring, the process deserves a pause. The goal is not to suppress confidence. It is to stop confidence from silently replacing the downside plan. Keep the thesis, position limit, invalidation condition, and new evidence separate from the emotional signal created by recent gains. The 24-hour investment decision checklist turns this process into a repeatable review before an unplanned increase. It cannot predict returns or prevent every loss. It can make the reason for the decision visible before pressure changes it. A stronger feeling may be real. It is not by itself proof of a safer decision.